Hey, it's Mike at Cross Country Mortgage, and it's time for your Monday morning mortgage update for the week of August the 25th. I hope you had a great weekend. It was a hot weekend, but hey, we've got some relief on the horizon. It's going to cool off in the next few days, and I can't wait. So let's talk about what happened last week, what's going to happen this week. I always try to give you insight so that you can make some great decisions when you're out there buying and selling property. So last week, we saw the week start out flat, stayed flat until Friday. Friday was a big day in the market. So let's look at the graph so I can show you what it really looked like. Now, this is a graph showing the trading of mortgage-backed securities in the bond market. This is where mortgage rates are determined by the trading of those securities in the bond market, not by the Federal Reserve Fed fund rate, which they raise and lower. And that's important for you to remember that. So if we look at the right side, you're going to see a big green wick. We call that a candlestick. Big movement in the market on Friday on the right side there. That means that money flowed into the bond market. Mortgage rates got a little better, and we'll take that. Why did that happen? Because all the economic financial leaders around the world were meeting in Jackson Hole, Wyoming. They do this every single year, and they talk about what's going to happen in the economy, make projections, what they're going to do. And Jerome Powell, our Federal Reserve Chairman, came out in a press conference and said, hey, we think that we're probably going to cut the federal fund rate on September. And everybody rallied. Everybody went, oh my gosh, the money flowed into the bond market. Mortgage rates got better. The media outlets said mortgage rates are coming down. Rates are coming down. This is amazing. This is great, because the Federal Reserve hasn't cut those rates in months. Trump has been pressuring the Federal Reserve to cut rates. Remember, the Federal Reserve has been raising the Fed fund rate, and then they cut it a little bit at the beginning of this year, but they've been raising that Fed fund rate to fight one thing, and that's inflation. And inflation is the death of mortgage rates. It cuts into the returns in the bond market. So the Federal Reserve has been has made some cuts in 2025 because there's been some indications that inflation's starting to get under control. It's not going down. We know everything's expensive, but it's not going up as much as it could. The other issue now that's driving the decision for the Federal Reserve to cut rates is the economy. Job numbers have been weak, and that indicates that, if people don't have jobs, they don't have money. If they don't have money, they don't spend money. And that is another reason why the Federal Reserve should cut rates. They shouldn't cut them because inflation is not under control, but definitely they should cut them because the economy is showing signs of weakness. Jerome Powell has been putting his foot in the sand and not wanting to do this. So this is the first time he's said anything like this in quite some time, and everybody rallied on it. Now, there's an important thing to remember here. When the Federal Reserve cuts the Fed fund rate, that's a short-term interest rate. Home equity lines, credit cards, auto loans, interest that businesses are charged when they borrow money, commercial rates. Mortgage rates are long-term interest rates. It's a different animal. And so when the Federal Reserve cuts that short-term interest rate, it does not mean that mortgage rates are going to go down. Mortgage rates are getting better. I've talked about this. They're trending better. There's no doubt about that. And mortgage rates did get a little better on Friday, but keep in mind, we're not going to see this big slice in mortgage rates in a couple of weeks when the Federal Reserve meets. Why? Because the bond traders, which is where mortgage rates are determined in the bond market, have already anticipated this cut. Yeah, they already projected that this was going to happen. And so they've already started, banks and lenders and mortgage lenders are already pricing in this cut now. And they're not just going to wait until the Federal Reserve makes a decision. They're getting ahead of the game. They always want to. It's the way that they can get business, because this is how they can drive business before the Federal Reserve actually makes that decision. So keep that in mind. Rates are already improved based on what's going to happen in a couple of weeks. So let's talk about what's going to happen this week. Three things: inflation, Federal Reserve members talking, and then some economic data. So on Friday, the PCE report's coming out. It's the Federal Reserve it's their main data point of inflationary numbers before they head into the Federal Reserve meeting in a couple weeks. So Friday could be a big movement in the market if inflation hits expectations or is better. If it's above, if inflation goes up higher than expected, that's not going to be good for mortgage rates. Second thing is Fed Reserve talking. So a lot of members are going to speak now. Are they in line with what Jerome Powell said Friday? If there's any dissension, that could affect the market up and down. And then the last thing is just a lot of economic data, consumer confidence, manufacturing numbers, jobless claims on Thursday. Pay attention to that number. If we see a lot more jobless claims coming out on Thursday, which would support the fact that we're starting to see a weaker economy, that actually could be a positive thing for mortgage rates. So we're starting the week floating, moving into a locking position. If we see any changes, if you have any questions about your mortgage rate, your mortgage, and you need help, I'm a mortgage broker and a banker. I've been doing this 25 years. I give you insight, but I'd also love to earn your business, so you can give me a call. Have a productive week. Have a great day, and we'll talk next week. Bye.